My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Strategic Financial Management. As prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is Discounted Payback. Discounted payback is a method used in capital budgeting to find out how long it takes to recover the investment, but with a twist, it considers the time value of money. This means future cash inflows are discounted, reduced to their present value. Why it's used? Unlike the normal payback method, this method is more accurate because money today is worth more than money tomorrow. Easy example. Suppose a company invests 1 lakh rupees in a project. It expects cash inflows of Year 1, 40,000 rupees. Year 2, 40,000 rupees. Year 3, 40,000 rupees. If the discount rate is 10%, the present value of inflows will be less than 40,000 rupees each year. After adding the discounted values, the company sees it recovers the investment in about 2.8 years. Easy to remember line. Discount the cash, then count the time, get back your money, rupee by rupee line. This method helps companies decide faster and smarter when choosing between risky investments. Next important short question is 2. Post-payback. Post-payback is a method used in capital budgeting to measure how much profit a project earns after recovering the initial investment. It focuses on the returns received after the payback period. Why it's important? The regular payback method tells how fast money is recovered, but it ignores what happens after that. Post-payback shows the extra cash flows that come in after the investment is recovered, helping to judge the true profitability of a project. Easy example. A company invests 1 lakh rupees in a project. It gets 50,000 rupees in year 1. 50,000 rupees in year 2, payback done in 2 years. 40,000 rupees in year 3. 30,000 rupees in year 4. The post-payback profit is equal to 40,000 rupees plus 30,000 rupees is equal to 70,000 rupees. Easy to remember line. After payback, count what's left, that's your profit chest. Post-payback helps businesses choose the project with better long-term gains, not just faster recovery. Next important short question is 3. Terminal value. Terminal value is the expected value of a project or asset at the end of its life or forecast period. It tells us how much the project is worth in the future and is added to the project's total value when doing capital budgeting. Why it's useful? In long-term projects, cash flows continue even after the forecast period, like 5 or 10 years. Terminal value helps capture the value of those future benefits in one simple figure. Easy example. A company runs a project for 5 years but expects to sell the machine at 50,000 rupees in year 6. This 50,000 rupees is the terminal value. It is discounted to its present value and added to the project's total NPV. Easy to remember line. End of the plan, what's it worth? That's your terminal value on Earth. Terminal value helps in making better investment decisions, especially for projects with long-lasting benefits. Next important short question is 4. NPV mean variance analysis. NPV mean variance analysis is a technique used to make better investment decisions by considering both expected return, mean, and risk, variance, of a project. What does it mean? Mean, average NPV expected profit from the project. Variance, how much the NPV might fluctuate. Higher variance means more risk. This method helps compare projects not just by how much profit they might make, but also how risky they are. Easy example. Project A. Mean NPV is equal to 1 lakh rupees. Variance is equal to 10,000 rupees. Project B. Mean NPV is equal to 1 lakh rupees. Variance is equal to 50,000 rupees. Both have same expected return, but Project A is safer because it has less variance. Easy to remember line. Mean shows gain, variance shows pain. This method helps choose projects that offer good returns with lower risk, making investment decisions smarter. Next important short question is: 5 Hillier approaches, explain limitations. The Hillier approach is a method used to study the risk in capital budgeting decisions. It uses probability distributions to estimate how much a project's NPV, net present value, might vary due to uncertainty. What it does? It shows the range of possible NPVs instead of just one value. This helps in understanding the best case, worst case, and average scenarios. Easy example. A company expects cash flows to vary due to market changes. The Hillier approach helps create different NPVs for different outcomes, like low demand or high demand, so the company can prepare for all situations. Limitations. Needs detailed data and probability estimates, which may not be available. Involves complex calculations, not always suitable for small businesses. Results can still be uncertain if assumptions are wrong. Easy to remember line. Hillier shows wide view, but needs strong data too. This approach is helpful but best used with good data and expert analysis. Next Unit 3. Long questions. First important long question is: project abandonment decisions, factors, discuss. In strategic financial management, a project abandonment decision means deciding whether to stop or discontinue a project before its expected end if it is no longer profitable or useful. Just like a farmer stops watering a plant if it won't give fruits, a company may abandon a project if it's wasting time, money, or resources. Why abandon a project? Key factors. 1. Continuous losses. If the project keeps losing money with no future improvement, it's better to stop. 2. Better alternatives. If a more profitable project becomes available, the company might stop the current one. 3. Changes in market conditions. If customer demand drops or new competition arises, the project may no longer make sense. 4. Legal or environmental issues. New laws or regulations may make the project illegal or too costly. 5. High operating costs. If running the project becomes too expensive, it may be wise to exit. 6. Technological obsolescence. If the project uses outdated technology, future profits may not be possible. Easy example. A company invests in a mobile phone production unit. After 1 year, newer and cheaper phones from competitors dominate the market. Sales drop and losses rise. The company does a cost-benefit analysis and finds that stopping now saves more money than continuing. So, it abandons the project and invests elsewhere. How to decide? Compare future expected cash flows with abandonment value. How much can be recovered now? If abandonment value future benefits, it's smart to stop. Easy to remember line. If the project is sinking, stop and start thinking. Conclusion. Project abandonment is a smart financial move when a project stops adding value. It protects the company from further losses and allows redirection of funds to better opportunities. Next important long question is: 2 multiple IRR, explain with example. Multiple IRR means getting more than one internal rate of return, IRR, while evaluating a project. It usually happens when a project's cash flows change signs more than once, from positive to negative or negative to positive. What is IRR? IRR is the interest rate at which the net present value, NPV, becomes zero. It helps decide whether a project is profitable or not. Usually, we expect only one IRR. But sometimes, we get multiple IRRs, which creates confusion. In such cases, IRR becomes unreliable. Easy example. Suppose a company starts a project with this cash flow. Year 0, 10,000 investment. Year 1, plus 21,000. Year 2, 12,000 shutdown cost or repair. Now look. Negative positive negative cash flows, signs change twice. When we calculate IRR, we may get two IRRs, for example. IRR is equal to 10% and IRR is equal to 25%. Which one is correct? That's the problem. Why this happens? IRR is based on solving a complex equation. If cash flow signs change more than once, the equation may have multiple mathematical solutions. How to solve this issue? 1. Use NPV method. Instead of IRR, calculate NPV at different discount rates and choose the one with highest positive NPV. 2. Use modified IRR, MIR. This gives a single rate considering reinvestment and financing costs. Easy to remember line. More sign flips, more IRRs, use NPV to avoid the scars. Conclusion. Multiple IRR is a tricky situation in capital budgeting. When it occurs, it's better to avoid using IRR for decision making and rely on NPV or MIR, which give clearer and safer answers. Next important long question is: 3. Adjusted NPV, define, compare with NPV. Adjusted NPV, or Adjusted Present Value, APV, is an advanced version of Net Present Value, NPE. It separates the investment decision into two parts. 1. Base case NPV, as if the project is fully equity financed. 2. Value of financing effects, like tax savings from debt. Then both parts are added together to find the adjusted NPV. Definition. Adjusted NPV is equal to base case NPV plus present value of financing benefits, present value of financing costs. It gives a more accurate picture of the project's value, especially when financing, like loans, impacts cash flows. Easy example. Let's say a project requires 10 lakhs rupees and earns profits worth 12 lakhs rupees over 5 years. If fully equity financed, its base case NPV is equal to 1 lakh rupees. The company takes a loan and saves 30,000 rupees in taxes due to interest deduction. Adjusted NPV is equal to 1 lakh rupees plus 30,000 rupees is equal to 1 lakh 30,000 rupees. This means the project is more valuable because of the tax savings from the loan. NPV versus adjusted NPV. Feature NPV, adjusted NPV, APV. Financing considered not directly, yes, shown separately. Simple or detailed? Simple, more detailed and flexible. Best when stable financing structure, complex or changing financing. Accuracy in real world, medium high, especially with debt. Why use adjusted NPV? Gives clear view of financing impact. Useful when using mix of debt and equity. Helps in international and risky projects. Easy to remember line. NPV tells you the profit, APV shows the full pocket. Conclusion. Adjusted NPV is a smarter, more detailed method than simple NPV. It helps you understand how financing choices like loans or tax benefits affect the true value of a project. Next important long question is 4. Impact of inflation on capital budgeting decisions. Explain. In strategic financial management, inflation means the general increase in prices over time. It reduces the purchasing power of money, which can affect both the costs and returns of an investment. When making capital budgeting decisions, ignoring inflation can lead to wrong project evaluations. Why is it important? Inflation affects 1. Future cash inflows may look high, but their real value is lower. 2. Operating costs, raw materials, salaries, and other expenses go up. 3. Project life assets may wear out faster in inflationary times. 4. Discount rate. It must match the cash flow type, nominal or real. Easy example. Let's say a project will earn 10 lakhs rupee per year for 5 years. If inflation is 5% every year, then 10 lakhs rupees received in year 5 will buy less than 10 lakhs rupee today. If we don't adjust for inflation, the project may look profitable, but in reality, the money earned will be worth less. How to handle inflation in capital budgeting? 1. Use nominal cash flows with nominal discount rate or 2. Use real cash flows with real discount rate. Never mix nominal and real values, this gives wrong results. Key impacts of inflation. Overstates returns if ignored. Increases costs in long-term projects. Can reduce NPV and IRR, making some projects look unattractive. May change investment rankings when compared properly. Easy to remember line. When prices rise, profits shrink, adjust for inflation or you'll sink. Conclusion. Inflation plays a big role in long-term investment decisions. To get a true picture of project profitability, always consider the effect of inflation in your capital budgeting analysis. It ensures realistic planning and smarter financial decisions. Next important long question is 5. Surplus life and surplus payback, bailout payback problem. These are advanced payback concepts that help in evaluating how long a project stays profitable beyond certain points. 1. Surplus life. It's the extra time a project continues to generate profits after it recovers the initial investment, payback period. 2. Surplus payback. It measures how much cash flows come in during the surplus life, the period after full payback. 3. Bailout payback. It's the time taken to recover the remaining investment after a project faces losses or extra costs, like bailout money needed to save the project. Example problem and steps. Imagine a project with initial investment 1 lakh rupees. Cash flows. Year 1, 30,000 rupees. Year 2, 40,000 rupees. Year 3, 50,000 rupees. Year 4, 20,000 rupees. Step 1. Calculate payback period. Year 1 plus Year 2 is equal to 30,000 rupees plus 40,000 rupees is equal to 70,000 rupees, investment not yet recovered. Year 3 is equal to 50,000 rupees, total is equal to 1,20,000 rupees. Payback occurs during Year 3. Payback period is equal to 2 years plus 30,000 rupees, 50,000 rupees is equal to 2.6 years. Step 2. Calculate surplus life. If the project runs for 4 years, surplus life is equal to total life payback period is equal to 4, 2.6 is equal to 1.4 years. Underscore 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 underscore. Step 3. Calculate surplus payback. Cash flow in year 4 is equal to 20,000 rupees. Surplus payback is equal to 20,000 rupees, profit after payback period. Step 4. Understand bailout payback. If in year 3, unexpected cost 10,000 rupees occurs, you need extra time to recover this cost. New investment to recover is equal to 10,000 rupees. Bailout payback is equal to time to recover 10,000 rupees from cash flows after year 3. Easy to remember line. Payback first, then surplus stays, bailout delays, but still pays. Summary. Surplus life, extra profitable years after payback. Surplus payback, cash inflow during surplus life. Bailout payback, time to recover extra unexpected costs. These help managers make smarter decisions by looking beyond just the initial payback.